So thanks for joining us for part 2 of this series with Jeremy Kessler from Steel Breeze Accounting and Tax. Today we're going to cover a topic related to what we can do in the current year to mitigate taxes when we're going to file next year. So stay tuned and hopefully get some value out of it. Thanks for joining us. So I'm going to shift gears a little bit to kind of go into, we're at October, there's still a couple months left in the year. And for most people, they probably believe there's nothing they can do to mitigate taxes for 2023, right, in the current year. But there are some things. And even for W-2 employees, there's still some options. So we're going to go through some of those. And I got to some basic topics and we can go through them, just give you some ideas to consider. But the biggest thing, obviously, we know is centered around retirement plans. And we always joke, and it was a book that we kind of reviewed a little bit and talked a bit about the win-win sort of wealth strategy, right? What's the IRS want us to do in terms of investments? Well, one is around saving for retirement, right? So qualified plans, 401ks, IRAs, that kind of space. So there's still time for people, right? So if you're a W-2 and you're contributing to your 401k, great, at least up to the match. That's what we recommend at minimum. And if you have more, go do that. But some other things too is to consider is you can do some IRA work, right? Put some stuff in IRA. So Jeremy, we talk a little bit about that, and can people do both?
Yeah, absolutely. And there's different things that you can do too. I mean, it's not a tax savings vehicle, but and I think we talked about this on the last episode. But the backdoor Roth, that's a great thing to do. You set up the traditional, you put the $6,500 in, and then you automatically just roll it over right into a Roth. And the benefit of that is that in the future, and we're always talking about the future, like you and I, and what our taxes are going to be. The best thing about the Roth is you're taking that money out and it's grown over the years and it's coming out tax-free. So that is like a huge benefit. There's a lot of money in the 401k, and the 401k is great. I mean, it's a tax deduction now, but you're going to be paying taxes when you're retired when you pull that money out. And a lot of people don't think about that. They're just, the W-2 wage earners, they're just putting money in the 401k year after year after year. And, it's a great thing, but they don't think about the back end of it and, what that means when they're retired. And that becomes a big expense in their retirement years.
Yeah, it's interesting you bring that up because I agree. And I don't think this is why you kind of go to people like Jeremy, because I don't think I've run this across a few different accountants and they don't have that same perspective, right? Because it's kind of a near term, I save money now. Well, what are the future ramifications of this? Well, I've seen enough where there's people with a lot of wealth because they've done such a good job saving, but their dollars are subject to a future tax rate is unknown. And so I kind of call it like an unknown debt. And your debt is paid to the government. We just don't know what it is. So the bigger and bigger that gets, the more problematic it can be. So, just like our diets, we got to balance it. There's a balancing act here, right? Too much of something may be bad in this scenario, and we don't know. And this is so, but in the current year, it's good, and certainly for business owners, they probably have a little more flexibility, and there's different types of plans associated with this, and we're not going to be able to cover off all the details of them, but like solo 401ks and even something as basic as a like a SEP or simple IRA. So there's definitely options to save for retirement. You got to kind of talk to your advisors to kind of figure out what might be best, but you could do that. But to Jeremy's point, it's a current year sort of tax reduction, but then the future is if your investments go up, that tax bill potentially goes up if tax rates are the same. Right, if you're at the same tax rate, which we don't know. The interesting one you brought up too, which was kind of my second part about this, thinking about Roth, because I think it's, that's obviously the flip side of it, right? You pay tax on money now and have that grow tax-free and then consumed and used tax-free is really a potentially good option, especially for folks who are maybe under certain income thresholds, right? So there is an income threshold to this. Right. To be able to do a direct contribution. But there are ways, as Jeremy said, backdoor type options where you can put them in non-deductible IRAs and, you know, convert them to Roth, right? So those are all unique options to get some Roth. So don't think you can't get in a Roth because you make too much money. There are ways around it,
Mm-hmm.
right, to do this. And to your point, conversions, right? Imagine you had, unfortunately, maybe a lower income year, right? And your tax rate's lower. This might be an opportune time to do a conversion if you have some cash hanging around somewhere, right? And now your future investments are all going to, in that bucket will be tax free when you use them, and for your kids, next generations, which is sometimes not always thought about. Like, what's the this IRA world and 401k world, that tax never goes away, and when it transfers to children, that will be taxed, right? So you can't avoid that.
Yeah.
But there are ways to get around this too. But
And that's also a way to just get around the unknown of what is our tax structure going to look like going forward. Chances are it's probably going to be a lot higher. You and I have talked about the fact that, Social Security, there's a big issue there. So how do you fix it? Well, raise taxes. And in that Roth environment, you're not going to be taxed on those dollars when you're pulling that money out. So it's a huge advantage to get into those structures for sure.
yeah, yeah, and there's a lot of people who use these sorts of interesting phrases. You don't get taxed on the seed or the harvest, and the fact of the matter is, that if your tax rates are the same, there's not going to be a tax savings or a tax benefit,
Mm.
right? We just don't know what it will look like.
Yeah. So why not
Right?
have both?
Yeah, so why not have both so you can have flexibility and options? And that's the things Jeremy and I always talk about is options,
Mhm.
right? Because what I don't want to have happen for people is everything has to work out
Yeah.
for you to win, right? That's almost impossible in my mind because we don't know what will happen in the future.
Hmm.
So having options and balance give you the flexibility to win and sort of shift your strategy as needed, as the powers that be in our government or whatever choose to change things,
Yeah.
change
And
the rules.
like to that point, actually, going back to business owners, I think there's something like 17 states now that have the mandated 401ks. That changes things a lot. Like you used to be able to be a business owner and put $66,000 or whatever it is now into your SEP, and now because they're mandating these 401k plans, you're limited now because there's highly compensated employee that whole
Mhm.
rule, and you can't just be a business owner and think that you're going to throw a bunch into your SEP IRA now. It's not the same anymore with these mandated 401k plans.
Yeah, it just shows you the complexity around these things too. It just sometimes boggles my mind, but
Mm-hmm.
that's why you need to get advisors to help you wade through it.
Yeah.
And the last thing I'll leave with this, because this is obviously a big area, what people are most at least familiar with, the qualified plan world is that, which we've talked about before, is that you can invest in things that maybe more about outside the market, right? And that's the self-directed side of the house. We're
Yeah.
not going to go deep into that, but there are options. You can invest in things that like real estate, like lending, whatever. There's a lot of different options outside to complement what you're doing in the market. But most people don't have that option, especially if they're company 401ks or the basic plans you have at these big companies. They're not going to offer that, right? Because they're rarely market based. So
Yeah.
there's also options to kind of expand what you're investing in, especially if things that you have interest or know more about. That's another route. And we have other topics coming along that way in the future. So kind of related to this around the qualified plan, which I thought is good too for this year, right? Depending on people's circumstances, is the HSA,
Mm-hmm.
right? Some of the high deductible plans for healthcare, like I find this is kind of the win-win-win where you can deduct and grow tax free and use it tax free. It's like the trifecta of goodness
Right. Right.
around taxes. There's not many vehicles that can do this. So, could you talk a little bit about the HSA lit and what?
Yeah. No, it's a great tax savings vehicle, like you said, and luckily, when I joined Deloitte years and years ago, they were very good about kind of setting us up and educating us. I mean, there was like it was like 2 days worth of discussing, the 401ks and the HSAs and all that stuff. And that's when I first learned about, an HSA. I didn't even know what it was, quite frankly, before I joined Deloitte. But it's a great. You get the deduction in the year when you're contributing, and like you said, like it's tax free, so it's an excellent savings. And look,
Yeah.
we all need healthcare, so it's like it's gonna you're gonna use it.
That's the thing. And to your point, the great part about those, if you're part of a high deductible sort of plan, these things don't expire. They're given at the end of the year, like some of these flexible accounts that you may have
Yep,
come across,
yep,
right? You get to roll them over and roll them and build them up. And to your point, that's the thing that's probably going to be the most expensive cost for anyone as they head into retirement for sure.
hmm
This is a scary thing. We'll get into that kind of as the kind of third part of this conversation. But to your point, I don't see healthcare costs going down anytime
no,
soon. So yeah, something to consider if your employer has different plans. See what kind of high deductible plans they have, or push them to get one, right? And offer it as a possibility. The other one too is like certainly for this year, and this is kind of why you talk to your advisors throughout the year because you're kind of managing kind of the wins and losses, and this is where you can potentially offset things like gains and from either your stock market or asset sales, and try to balance them off because this is where you can sort of balance any of the gains you got with losses and take a loss where you can, where it makes sense if it's an asset you didn't want anyway. So Jeremy, can you talk a little bit about that, like some of the harvesting and sort of what people should be thinking about?
oh yeah, sure. I mean, if you're the gains and losses offset, and that's just what it is. You got $20,000 gain, you can offset it with a $20,000 loss, and then you can only carry forward 3,000 a year, but the whole amount carries over. You can only deduct 3,000 of the loss every year, but the rest of the losses will carry forward. And when you have gains in the future, you can offset the with the losses. I have a lot of clients that work with their wealth managers, and they're doing at the end of the year they're loss harvesting and offsetting some of the other gains because they're you look at your investments, and you might have some losers in there. You might as well get rid of the losers when you have gains. Otherwise, you're not going to get the benefit in that current year.
Yeah, yeah, and you have to kind of figure out too because it's not like that's why it's the complexity around it, whether it's capital gains or income or however those, not everything's the same.
Right.
Right. So it's important to understand what's passive versus not. So there is complexity to it, but just understanding that there's potentially ways to offset some of your gains that you experience so they aren't taxable, and especially if you're selling something anyway, right? Or want
Yep.
to, right?
And that's a good point that you brought up passive. I mean, there's a lot of people that don't understand that when they get into real estate, it's passive income because they're not actively in a business. That's the difference between passive and active. And the passive losses aren't going to offset ordinary income. They're not going to offset capital gains. And when people first get into real estate, they get confused by that. They're like, well, I was told that I was going to have all these losses, and I'm like, yeah, you have those losses, but they carry forward and they only offset against the other passive income, and that's dividends and things like that. So
Yeah.
um,
It can get confusing,
yeah,
and I've
it,
heard
it, it
experience.
does for sure.
Yeah, that's what I've gone through it, and especially if people start broadening their horizons around business or types of investments, you just got to get really more educated about that and lean on your tax advisor to help sort of manage these things because I could imagine there's a lot of cases where people are just unnecessarily taking tax hits.
Yeah,
Um, with a little extra planning and thought, you can reduce that, right, in a given year. And for people who have like large capital gains, whether they're sold some big thing, and that's where you do need to talk to advisors and try to think about how you can get ahead of it. This year might be tricky with a couple months left, but if you do, there might still be options for that. So anyone who's listening may have sold a business or a large sale of a stock that was appreciated for so long, like those types of things, real estate, then you can, there are potential ways, but you got to kind of raise your hand and say this is happening, or I guess suffer the other consequence. You just pay a lot of tax, right? I guess it's not the end of the world, but we're trying to help you keep more of your wealth. Thinking about the different types of income streams and that we experience. And I think for most employees, W-2 earners, they feel like they don't have a lot of options, right? Other than qualified money, putting money into IRAs, 401ks. But one area that we know of and is certainly not for everyone is in the space of energy. And there are options for people with higher incomes and wealth to maybe partake in direct energy investments like natural gas drilling or oil and gas drilling. So these are different options. And Jeremy, can you talk just a little bit, a high level kind of how that could help like a W-2 earner if they understand the risks and get comfortable with a type of investment like that?
Oh yeah, there's depletion expenses within the you'd be basically investing into a partnership typically, and that's the structure that you're in these types of investments. And you get the depletion expense, and you basically have a loss on that investment in the earlier years, and then it's also an investment in the future years. So it's not like you're losing that money,
Right.
but you're getting a benefit in the earlier years, and then down the road, hopefully that investment will pay off, and you'll have some good capital gains on it.
Right, right. And even up front, like if it depending on how they structure these type of deals, there's like current law, right? The you know drilling costs, intangible drilling costs up front that could be applied against active income, right? Your
Mm-hmm.
W-2 income. It's very few things that can do that,
Right.
right? If you're willing to take a risk and be part of the general partnership and take on the associated risk with it, the government's telling you we want to encourage that, and so we're going to give you a tax benefit for that, and you can apply it against your active income. So these are definitely not investments to go into lightly,
Yeah.
because there's serious risks associated with it, right? And you got to know who you're dealing with. But they are for the right types of folks potentially options, right, to mitigate your active income and to your point, to Jeremy's point, maybe even get some tax sort of benefits on your income streams down the line, right, through the investment. So, but just
And
something to be.
that's like that book that you and I both read that you brought up before. The government wants you to do things that they try to steer you to do certain things with your investments, and this is one of them. I mean, that's why you get the benefit of those drilling costs, because this is something that energy is a big thing in the United States, and it's constantly changing,
Yeah,
and we're always looking for different ways to create energy.
and that's why I like things like, and we've run across them too, like solar, all the government credits that are associated with solar and investing in solar and alternative energies. And so those are things, again, to Jeremy's point, the government's trying to incent us down certain paths, and we could invest in those areas and then get tax benefits for it. We get it kind of de-risks our investments a little bit because the government's sharing in that with us. Now if things work out, they're gonna win anyway. They're gonna get tax money down the
Yeah,
road,
yeah,
right? So it's not like our IRS, the IRS or government are charitable, but they're trying to steer our economy and business and our country down a certain path, and we just have to pay attention, right?
the solar is a good topic too. I mean, I think I had four clients that made a solar investment on their, and I'm talking about on a residential in their own house. And it's a 30% of the cost is a direct credit. That's dollar for dollar on your taxes, and then most of them ended up in a very significant refund, and
Mm.
that is a true refund. A credit,
Yes.
credits are the only true refund. Everything else you've already paid in, but the credits, that's the one difference, and it's great. I mean, they're getting the benefit of, hopefully, it is an investment. I mean, the solar on their house. I mean, who knows where we're going to be in, a couple of years down the road. We might have batteries in our basements and could come off the grid totally. I don't know. I don't know if that's possible, but I mean, that's, I think, where we're heading, and that's why there are these credits, and who knows how long they're going to be around. I mean, these things, they're cyclical. Like, it's like the Tax Cut Job and Cuts Act. Like, that's only until 2025. So
Right.
that's right around the corner. I mean, time flies.
It will go super fast, and this is why you kind of have to get ahead of these things and learn more about them, right? It shouldn't be things you just blindly go into, so it does take some education.
Hmm.
Okay, so the next area that I thought was interesting to share was, there's obviously the government wants us to give to charity and help areas. So there's certainly charitable donations that we can do, and different structures and types of partnerships people could get into for the right circumstances to give to charity and also get some tax benefits to it. There's opportunities. Obviously, you can straight donate cash or possessions you have and take deductions, right? Or there's even more sophisticated things for people who are maybe have a large asset they're selling. They could donate that asset, like a piece of real estate or a stock portfolio that's appreciated, and you want to donate it to support a cause. There are ways that you can structure these to take some deductions, donate to your favorite charities or causes, and you both share in that benefit, right? The government gets their side of it by you helping others, and you get a tax break to it. So, Jeremy, any sort of additional thoughts around charitable? I'm not going to go deep into some of the specific strategies around this because there's a lot of different ones, but kind of any sort of 2 cents on kind of charitable donations and things that you see.
I'm seeing it more and more. They some of these things are called leverage deductions, and I'm seeing it more and more often lately. One of the clients that came in last minute, he's a doctor. He had a couple of partnerships that he, for his business, and I guess he got bored over COVID and bought a piece of land on the ocean down in Carolina, built up this huge house, and ended up having probably about $600,000 of capital gains. He bought
Wow.
it, rented it out for a year, sold it, and he knew he had all of this tax liability, and he wanted to do something about it to limit it. So he learned about this leverage deduction opportunity, and it decreased his taxes. And when I did the taxes, I got this all of his information, and I think I was actually going over with it with you because you and I have discussed it a lot. But what I did and he didn't even ask me to do this, but I saw it come in. I'm like, oh, this is interesting. So I put everything into his tax return without the leverage deduction, and then I calculated the return, put the leverage deduction in, calculated it again, and I took the two numbers, and he ended up saving, I think it was $165,000 in taxes. It's crazy.
Wow.
I mean, we're talking about this is a guy. He's a little bit out of the norm. I mean, he's a very high earner, but that just goes to show you, and it's all scalable. So anyone can do these things. It's just what's your risk appetite, and what are you willing to do?
Yeah, and that's really part of it. I mean, I think for any, some of these tax strategies, I guess you can kind of sort of call them investments, but they all come with unique structures and risks associated with them, and it's really just trying to get to the details of it so you understand what you're getting into and
Mhm.
whether you're comfortable with that risk, right? That's a really the simplest way I can explain it because
Yeah,
obviously, even our dollars sitting in the bank account have some degree of risk, right? Probably not as much these days as bailouts are happening at the bigger numbers, but there's still some level of risk.
yeah.
Um,
Depends
but
on
yeah,
what bank you're in too. Like if you're in Silicon Valley or a Chase.
yeah, the risk, the other side risk of it is like, okay, you maybe not make as much money. Inflation just eats it all away. So it's all different types of risk.
Yeah.
Right. So you just have to understand that. Yeah. So definitely charitable, like, and you mentioned like donor advised funds, like there's advisor,
Yeah.
like there's a lot of different ways to go about this. And so I love those kind of concepts. Like, can you do good and partner with the government, give you some tax benefits, and you actually help something, right? Help somebody or the community in some way. I think most people would want that win-win-win solution if they could. It just takes a little bit of open-mindedness and, just kind of exploratory work, right,
Hmm.
to find them. They're out there for sure. The one I know you had already kind of talked about before, this is kind of more for business owners, and there's still time to do this, right, Jeremy? If they are operating a business separately and it's a sole proprietor or just they could reevaluate their structure of their business, right?
Yeah.
To maybe 1120S and S corp, pay themselves salary. So those are all viable options towards the end of the year, depending on what's happening in your small business. So definitely, knows this like the back of his hand, but it's just something that to consider, right? Your entity structure, if it's appropriate, if it's providing all the tax benefits that it could. Some people believe, right, Jeremy, that like having an LLC gives you a tax break,
Yeah.
right?
People are often confused about that. All an LLC does, and it's state driven, and it's a liability coverage. It provides liability from someone comes in to sue you. They can only get the assets of the LLC. They can't go to your personal assets.
Right, right. So yeah, just misunderstandings or just haven't been exposed to some of the information on it. So these are just some of the kind of big areas. Obviously, we covered quite a lot of ground. That's definitely not exhaustive of all the different options, but I think it gives you a flavor for the types of things outside the sort of just what is typically talked about through whatever social media or things that are sharing these tax strategies. But there's a lot out there, and it's just trying to figure out if there's something there that fits your need or kind of where you're going. And you still have a little time, not a heck of a lot, but a couple of months in it, there could be some opportunities. So reach out to your tax advisor or even Jeremy here to talk through some of these things.
And you, Tom.
I know a little, but that's why I lean on tax experts like you and others, because I know enough to be dangerous. So thanks for joining us on this podcast. Hopefully you got some value out of it, and hopefully it will help you address your tax bill. But the next episode will cover what we can do in the future. There's a lot of unknowns as to where our future tax rates are going, but you ask any tax professional, most of them are going to tell you there's only one direction it's going up. And that's why it really requires us to get ahead of it, learn as much as we can, and get the right experts to help us put things in place. So hopefully you enjoy our next episode on the future of taxes and ways we can hopefully mitigate some of the burden it has on our wealth.